While you were presenting, I tried to, as usual, to combine questions or organize them into groups. I'm sending them to you now. And let's start, as usual, with questions relating to our 2021 results. The first question touches other comprehensive income, which we in fact did not report fully. The question is, other comprehensive income was not fully recognized in Tier 1 TCR. This is the first question or statement, actually. And then, why using this approach if there is enough room or surplus in your capital ratios?
Yes, so first, of course, we will report much more detailed data on the 21st of February when we will publish our audited financial statements. But looking concretely to the question about the other comprehensive income and specifically about the valuation of the bond portfolio, obviously the bond portfolios were affected by the significant increase in yields that happened in the fourth quarter. Even though we had not a long duration in our portfolio, but as everybody knows, all parts of the curve, of the yield curve, were affected, and so we applied as a capital treatment what is foreseen in the CRR, in which we treated the change in equity valuation of bonds, which was in the fourth quarter. There was a depreciation of close to 700 million zlotys, capturing 30% of that impact in decreasing the own funds. So this is according to CRR. So in 2021 we applied this 30% of this negative valuation. In 2022 it will be 70% of the valuation. But of course, what will happen during the current year is that part of the negative valuation of the portfolio that existed in the end of 2021 will disappear due to the fact that some bonds will be approaching maturity, and so part of this negative valuation will in fact flow through the lower NII of this portfolio in the next periods. So as a consequence, the capital impact was minor.
Second question on the past would be on the cost of risk in the corporate book. Write-backs in the corporate loan book continued. When do you expect normalization and at what level?
So first, we did not have a relevant growth of volumes of corporate loans in 2021, as we have shown. The book overall grew 3%, but of which leasing and factory grew, but corporate loans decreased, as we are showing on the page, on one of the last pages of the presentation. So on one side, we did not have, let's say, relevant impact from volume change. Second, we did not face deterioration of the quality of the portfolio, rather the opposite. The third, we cannot forget that in general companies benefited from a strong financial support during the pandemic, which allowed them, most of them, to keep a very solid financial position. And there was a recovery of the economic activity in 2021. Having said that, of course, the year 2021 was extraordinary in terms of having low cost of risk. When we presented our strategy 2 months ago, we mentioned that our average level that we would expect for cost of risk would be around 50 basis points per year. Of course, now there will be some other factors that at that time we could not anticipate, such as higher than expected interest rates, some cost pressure also that is affecting in general the economy, including companies. So we expect some normalization throughout the year, but we are still not seeing, for the time being, signs of deterioration of the portfolio. But of course, it's something that we will need to monitor through time.
Thank you. Now, a very detailed question regarding our fourth quarter results. What were the drivers of other admin cost quarter-on-quarter growth in the period?
So it's relatively simple to answer. So usually admin costs. So first of all, to say that staff costs were flat versus the previous quarter, which I think is something that should be highlighted, taking into consideration the significant pressure that is happening now in Poland, and also looking at the overall growth of staff costs in Poland, which is at levels of close to 8 to 9% year on year. So still to keep stable staff costs in the quarter, we believe was an achievement. Looking at the admin costs and depreciation, the increase in the fourth quarter was mainly driven by three items. One was much higher marketing costs in the fourth quarter. The second, legal costs connected with our FX mortgage portfolio, and the third, and counterclaims that we had to submit during the fourth quarter. And the third connected also with the higher consulting costs, taking into consideration the number of projects that we were doing in the last year, including the update of our strategy that was announced in December. So these were the major drivers. Overall, we still think that there was a significant improvement overall in the cost last year, despite these negative pressures, because we continue to be able to capture savings in different cost items, which helped to achieve this overall full year result.
Thank you. A question now maybe for João. If you could comment on consumer loans dynamics in the fourth quarter. After a strong pickup in 3Q, there was a slowdown in 4Q.
Well, mainly it was a slowdown in demand. The consumer loans are they have some seasonality also here in Poland, or especially for us. They are very connected in the second and third quarters, connecting with refurnishing, traveling, improvements, and in the third quarter and fourth quarter sometimes is a little bit slower. Probably also the idea of the change of interest rates, but also the comments, the articles, the informations in terms of increase of interest rates, they would require some time also for the consumers to adapt to this new reality. From what we noticed, it was a slowdown somehow everywhere, and we believe that this is normal, and probably this will be a trend that we will see in beginning of this year, in this first quarter, because even if there is a salary that compensate when there is inflation, increase of prices, higher taxes, and then higher interest rates, usually for the Polish consumer, they take a position of prudency and some slowdown in terms of lending.
Thank you very much. I think we mostly answered questions relating to the past, so now questions on 2022 and further out. Some of them are very direct, actually, because some analysts are asking, what do you expect on your NII line, fee line, cost of risk line? So we will not be that direct in our answers. needless to say that some banks on the market do not want to discuss future at all. But we won't be that far going. So let's try to do it in a more elegant and somewhat, let's say, intellectually challenging way for you. So you don't get a free lunch. First of all, the question is on the outlook for NII in 2020. But along this question, there's another one which asks about the new NII sensitivity in the current interest rate environment, and also what is the outlook for deposit costs after the good management of deposit costs so far. So like 3 questions, but around NII and NIM.
So I will try just to explain the drivers, but of course we are exactly now in the middle of a period of unexpected, just a few months ago, and on the other side very sharp increases of interest rates, and we are still in the middle of the process. There is an expectation that next week interest rates will move up once again by 50 basis points. And so we are not yet in a new level that we can consider as stable, that will allow to have the full picture going forward. So what I'm going to say also needs to be taken with the proper, let's say, reserve, due to the fact that some effects are still not fully clear. But in general terms, what we can say is that, first, it is visible that NII already strongly increased in the fourth quarter by 15% quarter on quarter, and also the NIM moved up to close to 3% in the quarter. And this is still only with partial recognition of the process of increase of interest rates which happened in the fourth quarter. The second thing is that, as I mentioned during the presentation, most of the loans reprice quicker than the deposits, as it happened in the opposite direction as well. So it means that in the short term, we are amplifying the effect, but there will be a moment in which also there will be some increase in the cost of the deposits. But for the time being, we of course, we expect the NIM to continue to increase. In fact, in December, the NIM was already above 3.2%, just in the month of December. So it's obvious that for the first quarter, we can expect a NIM not lower than 3.2%. The second point is that regarding NII, where we had this 15% quarter-on-quarter increase, in the first quarter we are still going to continue a relevant improvement on one side, but the full picture for the year is a little bit more careful, due to the fact that while we can benefit from higher level of interest rates, at the same time we will need to take into consideration the potential impact on volume growth, which, as I said, is still too early to assess, but of course we see some signs of lower origination of mortgage loans in the recent weeks, and also consumer loans, although January is not the ideal month to be able to assess the real demand for consumer loans. For the corporate, the picture is still not fully clear, so we still need some more time. So what we can expect is, first, clear improvement of NIM, as I said, in the first quarter at least 3.2%. Second, NII still in the short term improving due to this different speed of adjustment of remuneration on the asset side versus costs on liability side. Third, the NII also being favorably supported, but at the same time anticipating that at the end of for the full year, the volume growth may be lower than we were initially expecting several months ago. And for example, one thing to illustrate this is that there is somehow the market consensus that origination of mortgage loans during the current year will be 10 to 15% lower than in the previous year. So this is just a, let's say, illustration that there may be some impact on volumes, which according to our current views, will be more than offset by the improvement of the overall margins.
Yes, I think it's important also to understand that behind this there is always a lot of consumers and in different timings, and exactly what Fernando said. So it's the lending is immediately, and that's why it was so painful, the decrease of interest rates, because the lending is immediately, and liabilities take more time, but then we start by the term deposits, a little bit longer tenor, and it takes some months to go to savings accounts in terms of repricing. Maybe in long run we can expect also some changes of mix, because there was a major change of consumer behaviors, because interest rates were so low that people left all the money in current accounts. So it's normal that there is some shift here. And also with the higher interest rates, also the maximum rate and the usury rate can be higher. And here we will see if we will see what is going to be also the changes. Of course, this is a positive impact, but for us it's a little bit too fast. So we would prefer that these interest rates hike would have started 6 months before at least, and more announced and slowly, because it's also disturbing a little bit the normal equilibrium in terms of market, the management of the clients, of their installments. And there is always, we remember very well when the interest rates were cut to zero, that somehow the consumers were giving the responsibility to the banks. So the banks were guilty because they were not giving a decent percentage in time deposits. So it's very clear that once again we will be guilty because the installments of the loans will increase. But so we would, of course, prefer in commercial terms to have this in a more smooth way.
One question is touching on NII, but not directly. An analyst is asking whether we see accelerated prepayments of retail loans, and if so, do we expect this trend to have any impact on our small SUE, as we call it here, provisions?
So what we can say, so first of all, we were surprised in the morning to see this question. We were not expecting to have this question. But from the information that we have, there is a small, but very small increase of early repayments, but it's still in the immaterial level. So when compared with what was happening 6 or 12 months ago. So there's a little bit of increase, still too early to take conclusions from that. This is the first thing. Second, most of the time we did not charge commissions when selling mortgage loans. It was not always, but most of the last 10 years or 15 years, as far as I remember, in most of the years we were not charging commission when granting new PLN mortgage loans, as it has been the practice, for example, in the last 12 or 24 months at least. So it means that there is no such thing as a small SUE, at least that we can anticipate, regarding the potential early repayment of the loans. This is what we can say for
and in consumer loans, we have already a pure mechanism that's already offsetting and accrual and
returning immediately.
Returning immediately, but also accounting as the time is happening. So it's not there is not an issue here.
Thank you very much. Then there's a handful of questions regarding fee outlook. There's one direct question: what is the fee outlook for 2022? there's also a question, do we plan to continue charging customers deposit fee? And yes, I think these are the two key questions on fees.
I can go to this last. It's obvious that this, in principle, will not happen. We will see how it's going to be the end of the year. But if we are talking about deposit fee of high volume deposits at the end of the year, with a low probability, at the end of 2022, it will happen. We will see, but there will be for sure a change in the compositions, and also I think the analysts should be prepared to see, even also in retail, some changes of the mix, because during the decrease of interest rates, there was some composition in consumer loans, a little bit of more commission or more insurance penetration, and as interest rates go up, probably we will have more revenues on the interest part, but a little bit less elsewhere. So there is always some offsetting of this part of the commissions versus net interest income when the interest rates go up.
Okay. It was already answered.
We're moving to further down the P&L. One analyst observed that HR costs were flat year on year for the full year, despite 8% growth in workforce. And is this a sign of wage pressure, and what in general should be expected for HR costs in 2022 and 2023?
I think some time ago I was in an event with colleagues from another banks, and somehow I was surprised that the people were considering the biggest threat not Swiss francs or geopolitical challenges, but the labor shortage and the war of talent. And it's obvious that this is a big challenge. We will see also our peers how they will relate. Since the beginning, for us, it's very clear that we need to offset the salary pressures through efficiency, and this is a little bit what we have been pushing since the beginning, since 2020, when we start to push a little bit further the synergies from the merger. Then when we went through different process that we explain here, like a completely re-engineer on the mortgage process, that is a very labor-intensive process, in order to achieve results, we would never be able to make the volumes that we are making at the moment without this re-engineering of the process, because it's gave us a competitive advantage, but also give us a efficiency and this capacity. So, so first of all, this salary pressure is here for staying, and we should expect that we will have per head an increase of cost of HR costs, and we will try to offset partially. We will never be able to offset completely, but partially, by being more efficiency, and by that having a lower headcount. But also, please remember that also the mix will change. So as we become more digital, the workforce of a bank is changed completely of a pure traditional branch-based bank. So also the cost per head changes.
Thank you very much. I mean, obviously, our colleagues who certainly listen to the call will probably be very pleased by the first part of your answer, probably less pleased by the second part of the answer, but okay. That's the banking reality. Now, questions relating to cost of risk. And first, very direct question is, what cost of risk and CHF provisions do you expect in 2022? But in a more elegant way is, what are your cost of risk expectations and what will be the impact of higher interest rates on those? What is the maximum level of interest rates manageable from assets quality and cost of risk perspective? This is an interesting question.
So it's an interesting question. Of course, it's not easy to answer, right? So as I mentioned, we had this sudden, very sharp increase of interest rates, which so it means that the full impact of the increase of interest rates on installments paid by customers is still not fully reflected. So this is the first comment. The second is also that the impact depends on not only on the increase of the installments that happens for different types of credits, but also to other variables such as what is the evolution of the remuneration of people, and we know that there are multiple factors here now on the table. We have on one side increase of minimum salary in Poland by 7.5% in January, which drives also some growth, general growth in some other lower, let's say, lower base salaries. The second thing is also there was a change in the taxation system, which also triggers changes in the disposable income for different classes of individuals. Third, there is a high inflation. Number four also is the fact that when granting the loans, of course, the bank adopts scenarios that are not exactly the ones that are in force at the moment of giving the loans, but also assuming some changes in the interest rate. So it's still too early to make a full assessment about what can be the potential impacts on asset quality of this increase of interest rates. We are, for example, just as a reference, in September we had WIBOR levels at around 0.2, 0.3%. Now they are at 3%, and the NBP rate moved from 0.1 to 2.25. There is the expectation that can still go to 4%. So it's completely in the period of 6 months, everything has changed, and we need to analyze carefully the potential implications. But for the time being, our base scenario for the cost of risk in 2022 is the one that we have disclosed during our strategy presentation, which would be some kind of normalization at around 0.5% per year. And this continues to be our base scenario. I think that we will see the first impacts coming from the demand from loans, probably. Then we will see if there will be relevant impacts in terms of asset quality for specific classes of customers. And again, just highlighting that in principle, if everything that we said will be confirmed, let's say lower segments with lower remuneration would have a higher increase of disposable income versus higher segments of remunerations. But we will need to see in practice how this will unfold.
Thank you very much. There's a handful of questions which circulate or center around on outlook for lending and demand for lending for borrowing given higher interest rates. But I think we largely touched upon it, so unless you want to elaborate. Okay, we already answered these questions. There are two questions about our capital requirement. First is, do you expect capital requirement to drop in 2022 as a result of CHF provisions and amicable conversions? How big could this impact be? And second, about sensitivity of capital to higher interest rates and whether we have made any precautionary measures.
Sensitivity of capital?
Mm-hmm.
So regarding the first question, our objective is to reduce the share of FX mortgage loans in total loans to below 10% as quickly as it will be possible, in order to create the possibility of removing the additional capital add-on that we have for FX mortgage, which is still significant. And as we presented during our strategy, we believe that this is possible to achieve until 2023. So it can happen sooner or later, depending on the pace of reduction of the FX mortgage portfolio and the growth of the other loan portfolios and evolution of FX rates. So there are several factors that have influence, but we have this clear objective of bringing down the share of FX mortgage in total loans to below 10%. If that, when and if it will happen, it will allow us to be entitled, in principle, to benefit from the elimination of the Pillar 2 buffer, as it happened with several other banks in the past, if the methodology will not be changed. And so this can happen, as I said, until 2023. If it will not happen in 2022, at least we would expect an update of the Pillar 2 buffer, as usual, once a year in the fourth quarter. So I think this is the answer to the first question. Regarding the second question, I think I will try to answer in a simple way, is that with higher interest rates, we will have, in principle, higher recurrent results. Higher recurrent results means higher profits or lower losses, whichever is the, let's say, the forecast. So from this perspective, it is beneficial. There is a short-term negative impact, which was we already discussed, which is the valuation of the bond portfolio, which, as I said, has also some capital impact according to the regulations. But also we know that part of it we expect to be eliminated during the year 2022. So.
And the biggest impact was already achieved because it's already embedded interest rates at 4%. So unless there is another movement of another 4,
yes.
So if we are talking about more 50 basis or less, so the big jump was already done.
Yes, exactly. So that's why we would expect it to, although it will count more for in terms of the coefficient that will be applied, the absolute amount will be smaller. So generally speaking, higher interest rates should give us support for further improvement of the recurrent results, even if we will be facing some higher costs on one side due to the inflation pressure, and some higher cost of risk if it will happen due to also to the higher interest rate environment.
Thank you. And last but not least, we have received questions relating to Swiss francs. But without this, a conference call wouldn't be complete. This time, actually very few questions, I have to admit. They're mostly around decreasing number of lawsuits, whether we see this in the fourth quarter, whether we see it as a seasonal thing or beginning of a trend. How do we see our provisioning buffer? Do we think we need more provisions? Then there are questions about the settlements, mostly about expectations, and if you could share what is the progress in January and whether we see any seasonality or correlation with high interest rates.
So that's, we would not to give some too optimistic expectations in terms of decrease of court cases. So it's true that in last quarter it was smaller, but in our view the movement is still negative in terms of flow of cases and in terms of decisions of courts. So a although we are confident even in the cases that were related to the bank in European Court of Justice and also the cases of Supreme, where we will try to make our position, we are working in this less positive scenario, and so it's we are not expecting a huge decrease, even if there is a slowdown, a huge decrease or a new trend of lower court cases. This is the first point, and also we are not expecting a turnaround in terms of court decisions. These will reflect what we always said, that the year of 21 and 22 were years where we would have, in our view, the biggest impacts in terms of provisions and costs for the solving the legacy portfolio, and this is what we are doing. We were a little bit surprised. I think that I said in the meeting 1 quarter ago that our view would be more a 2000 level of settlement, so it was a little bit more than we were forecasting. But I'm quite optimistic. I think that we have a good structure here, so I cannot say if it is 2,500, if it is 2,000, or if it is 3,000. So it's very difficult to forecast. Each customer is a customer. Each reality is a reality. January, for example, it's winter holidays. There is a lot of people, in fact, staying at home in quarantine. So it's not extremely positive. But we believe that the capabilities that we had in that time, we will keep having it. So once again, 500 more, 500 less. But we believe that. We will be able to reach agreement with customers as we have been doing up to now. Higher interest rates is, of course, a challenge, but this is a combination of FX discount and a conversion with an installment. So it's in the way that we are doing, we are seeing case by case. So and when there is willingness to find the settlements, we will be able to find it. So we see as a continuation what we have done up to now. We don't see as a big transformation from what we did up to now. So it's obvious that the situation is still not finishing as we would like. But it's clear that the next year will be, again, as it was already this year, but a major step to solving this saga. By settlements, by provisions, by counterclaiming, so by several ways, but it will be.
Just, of course, to reinforce the idea that, of course, we will try as much as it is possible that the recurrent results of the bank that we expect to improve during the year will absorb a larger part of the additional provisions in case they will need to be done during the year 2022. So it's difficult to make forecasts about additional provisions because it essentially depends on inflow of court cases, the nature of the court decisions, and plus a number of other aspects in clarifications that are still which are still before us. So and these can determine more or less need of provisions, but of course we are still anticipating the continuation of the need of making provisions. What our expectation is that we will be able to generate higher recurrent results that would absorb a larger part of this additional cost when it will come.
Also to add, I've listened to the morning call with media, and it's worth sort of repeating what was said there, namely that when you think about the sensitivity or propensity of customers to convert into zloty, sensitivity to interest rates, also remember that some people simply pay off the loans, so they are totally insensitive to interest rate levels because they want to repay. and all the thereafter is
After conversion,
attractive,
they will repay.
attractive exchange rate. Okay, Fernando, any questions that we omitted that you particularly would like to answer?
Just final checking.
Okay. So that was a minute or two. As you see, we're very diligent and try to answer all questions that arrived. Nothing to hide.
So when Fernando is checking the last questions, I will just put a little bit our view in this year, because somehow the year when it started it was confusing for us, because 2020 was a very challenging year due to COVID, protecting our people, the customers, business continuity, and then the moratoriums, support to the companies, programs with the governments, all of these. And then we start to have this dream that now is coming the vaccine and everything is finished. So it's and suddenly the things is, as Fernando said, 2 years passed and we are still here in these videos and everything. So it looks like that the year somehow there is always this taste of a so-so, and for us it's important because we had the supervisory board last Friday, and so it was always a reflection, and for us it's looks to us that we made a major movement in terms of solving the legacy issue. So between the settlements, between the amounts that we create provisions, between the capacity for the bank in terms of defending their interests and argumentation, even in terms of operational level. So we are today as operating in courts in massive cases, which takes a lot of challenges in operational terms, in the operational risk, and at the end of last year we had all of these waves of counterclaims that the bank had to put. So it's but we are quite happy that to all of these efforts is clear, visible, and also assessed by the market that the bank made a major improvement in the direction of solving this legacy. At the same time, and doing simultaneously, so the bank also made a major improvement in terms of revenues and in terms of cost control and efficiency, and it's very positive, because it's we always had this dream of achieving 1 billion zlotys of net profit. We didn't achieve it yet, but if we deduct the FX costs, we'd achieve it. And in operational level and in commercial level, this is very important, because it's a clear indication. And this is before the interest rates, because we have the 1.1, and 1 is the impact of 0.1 is the impact of the interest rate. So we adjust by natural business, by managing the business, the volumes, the interaction with the customers, the efficiency and cost control. And on top of that, in this strange year also, we put it out, this strategy for the next 3 years that we present in the last meeting, and it was well assessed by all of you, that we are very happy for that. This is also, besides we don't do it as just an exercise to the analysts. We do it mainly for ourselves and to be able then to roll out. We are in full rollout mode on this strategy, and going through all of the plans that have the components of the strategy that we present to you, and so we are. I would say that we are very optimistic for the year of 2022. So it's there is a mood a little bit around the country at the moment, a little bit like the weather today, so very gloomy and a little bit grey, because it's inflation, it's the new taxation, is the geopolitical challenges, whatever, but we are quite optimistic, and we are optimistic also for the economy and for the capacity of the country to react well to these situations. And we are particularly optimistic for our business. So it's, of course, low interest rates. It's always a very challenged time for the banks. Now with good economic growth, the bank being prepared, higher interest rates, and then a more dynamic and normal economy and life of people, we are very optimistic for the prospects, or with the prospects of the bank and the bank activity for the future.
João, thank you very much for your optimistic comments, and given the grayish misery of today, but the spring is coming nonetheless. So
it will take a while.
Okay, gentlemen, thank you very much for your time, your presentation, and your answers to questions. Thank you very much, the audience, for listening in and your interest in our bank. We will meet with you on the 26th of April, so there will be a little bit of breathing space, and we will not bother you unless you attend one of many conferences that brokers are organizing between now and end of April. It's the 8th time that we're wishing you health and safety, so unfortunately this, although it's actually good wishes in general, but stay healthy nonetheless. Keep up the good work, good luck in what you do, and see you soon. Thank you very much.